Hey, good morning, everybody. If you could please take your seats, we're going to get started. It's great to see everybody. I know we have a big crowd. We have a lot to cover. The programs committee put forth a great schedule this year of topics for our chapter meetings. I know everyone's excited to hear from our multifamily experts. I do want to begin by thanking our gavel sponsors. You can see their logos identified on each of our tables and up here on either side of the stage. I know there's some new sponsors, so really appreciate your commitment, and thank you to all of the sponsor representatives that are here this morning for lobbying for our support. I know Tom Frank taking on the executive director role is not such fresh news, but we're excited to have him. I'm not sure where Tom is. If you could, there he is. Congratulations, Tom. Thank you. Yeah. Tom was able to join us, 7 board members and members of the advocacy committee earlier this week for the NAIOP annual chapter leadership and legislative retreat in DC. We're going to share some information about what we learned. NAIOP corporate generated 3 white papers surrounding real estate issues that the federal government can help us solve, or at least help. So we'll make sure we get that out to you maybe next week. We also got to see Brian Walker in his chair role on a national stage, which was awesome. He did a great job. Obviously, it comes to no surprise. Brian represented us well, and he also generated curiosity about what's happening here in our market. Some upcoming events to keep an eye on. We have the DL Project Tour. The DL Project Series kicks off next month with the Project Tour at the RDC's Cary Furnace site. We, of course, have our March chapter meeting, which is a little different. We're having a happy hour with some other folks. That's going to be on March 26th. A regular chapter meeting presumes in April. And, of course, we have our awards banquet, our national banquet, our annual banquet, excuse me, in May. The award nominations are now open. They just opened. Please submit projects. We need all projects to be submitted in order to select the right ones for each individual award. So, all right, I'm going to kick off the event now by introducing John Deklewa. John is our moderator. He's also the CEO of RDC. I don't think we can describe Pittsburgh multifamily market without him, and all of that RDC has accomplished over the last several years. We've seen delivery of monumental projects such as Brewer's Block in the Strip District and the Foundmore in Ross Township. We've also seen transformative announcements for upcoming projects like their plans on the North Shore. John is a member of NAIOP Pittsburgh board and a dedicated advocate for our industry. Welcome, John.
Thank you. Good morning, everybody. I'm John Deklewa, President and CEO of our RDC Design Build. Can't say much more than Brandon did, so thank you for that. We have a great panel for everybody here today. I think we're going to get into some really interesting things going on in the market, and I'm really excited to introduce our panelists to you. First one is Laura Lawrence, Executive Vice President of CBRE Capital Markets, Multifamily Division. Next up is Brian DiPietro, CEO of Rockit Architects. And last but not least, we have Anthony Calabrese, Director of Real Estate for Greystar. So please join me in welcoming them, and we're going to get started. So we're going to get right into the core of what's going on in the market, and that is interest rates. The 10-year is at around 4.3%. Prime is over 8%. It's causing a lot of people in this room to stress out. Projects are in limbo. And I wanted to start with Laura. What do you see out there? We know talk of rate cuts have cooled. What can you tell the group here?
Okay, this is working. Hi, everybody. So I think right now stability is the name of the game. So in market fundamentals, which we do offer here in Pittsburgh, in asset performance, and in the financing markets. So even if you have great market fundamentals, good, strong NOI growth, if the capital markets are seeing the volatility that we've seen, unfortunately, it just means investors are on the sidelines. So not completely out, but when investors aren't as active, it really means we're not seeing as many tours on our projects, not seeing as many bids, not seeing, the activity on the bid sheet means less competition, less driving in price. So change, has a trickle down effect for sure. Monday, it was exciting to see the rates drop down below 4 a few times over the past 6-8 weeks. And then Monday happens with the inflation announcement, and we see the long-term rates kick up. And when you're at a 4.2 or 4.3, say you're at a 4.2 10-year treasury and a 180-point spread, luckily spreads have come in, but there you are at a 6% rate. You know what that means for cap rates. Cap rates have really shifted up over the past couple of years. So it's just a shift. Overall, conviction around multifamily is really strong. Renters are still renting. We have a young population here in Pittsburgh. 32% of our population is 20 to 34. And those folks are renting longer, which has been fantastic. It's 40% more on average nationally to buy a home versus a monthly rent payment. So we really feel good about the future of multifamily. Have more and more calls from folks saying, we want to allocate and shift into more multifamily in our portfolio. So feel good about that.
So with cap rates, how does Pittsburgh look compared to other cities that we compete against? Are we still competitive? Is Pittsburgh still a place where investors and institutional investors primarily are looking to invest?
Yeah, I mean, we're still seeing cap rates in the 5s. Obviously, like I just said, we've come up in cap rates for sure, but still a very positive place to invest. Green Street, which is a reputable independent source, just ranked Pittsburgh number 5 in all U.S. markets. This is huge for us in a growth metric that actually compiles both rent growth and occupancy into one single metric. So great news there. We have outsized rent growth due to our high occupancies. And, like I said before, stability is the name of the game. We had a lot of institutional investors saying in the past few years, we're going to the Sun Belt, we're following rent growth. Well, now they're going to follow it back here, which is going to be great in the coming years.
And Anthony, when outside capital comes to Pittsburgh, oftentimes you're the first one they call. What are you seeing as far as outside investment?
Yeah, so a few years ago, we did have a lot of institutional investors that we work with in other markets express interest in the Pittsburgh market. That has cooled off slightly. However, the clients that we do work in the market are still bullish, and they are in acquisition mode, so they are actively looking for additional assets. Now, I would say over the past 6 months or so, the investors that had been looking, back in 2021, 2022 are starting to come back around as they see that Pittsburgh has just a very positive story. I don't think it's any secret that there's, potential for a lot of turbulence in other markets nationwide, and Pittsburgh's very well positioned to not fall into that category. And that's something that, we're really impressing our investors upon. Aside from, our third party clients, Greystar is also very heavily invested in the Pittsburgh market, which should also be very telling, right? So from student housing, third party, where we've grown pretty exponentially over the past 3 years or so, our development group is very active with 2 active projects and 2 more in the works. So, really positive outlook.
So demand is still outpacing supply in the Pittsburgh market. Is that a national trend? Is that something unique to what you're seeing here? And rents are growing according to most of the reports I'm looking at. What are you seeing?
Yeah, so we're seeing that rents are growing. Now they are cooling off. They're not growing at the same rate that we saw, post 2020, right? But we're getting back to more stabilized years. So we are projecting, that 3 to 4% for the next several years. As far as supply, historically, Pittsburgh has had a very healthy supply line, which has aided it in that rent growth. Looking at historical averages, with the exception of 2016 and 2022, Pittsburgh has been below half of the supply delivered based on a unit percentage that's already in the market. So again, I think that's very telling. And what that's, afforded is those that are delivering those assets a very healthy absorption rate. And again, that all then goes back to the ability for rent.
And Brian, you've got your fingers in a lot of multifamily projects as well. What are you seeing, and what challenges do you see to trying to increase the supply here in the Pittsburgh metro?
It was on. Okay. I think it's really just trying with everything that's going on right now with the markets and everything. I'm seeing firsthand a lot of hesitancy to pull the trigger with uncertainty with the markets. You know, we have a project that we're looking at right now with a client, basically saying, hey, we're gonna wait and see what happens in the first quarter, where interest rates are, what they're doing. As an architect, what I looked and try to do to help things along is, okay, are there additional sources of revenue? There are additional things that we can do with the design to kind of help move things along and help aid things. Prior to being at Rockit Architects, I was at WTW Architects for 17 years. I was a partner there at the end, basically in charge of the multifamily and the student housing. Worked on, I think it's somewhere around 6 million square feet of, or 6 million square feet of multifamily and student housing combined. A lot of that work was with EDR Trust, Allen O'Hara, which is, you know, Greystar now. What we learned is with them, what I learned firsthand working with them was a lot of how the pro formas work, what the developers see on their side of things. So as an architect, I try to integrate that, making sure that when we're doing a design, does it work financially? If there's something that I see in the design where I can squeeze out some square footage or add something that might cause you guys to be able to increase the rents a little bit, not just maybe not reducing construction costs, but maybe increasing revenue over time, that's just as good, if not better. So I think it's kind of sharpening the pencils a little bit on the design side of things, looking at the construction costs and also potential sources of revenue to help things.
So if you could share at all about some of the projects you're working on, and are you seeing, you know, there's a lot of talk about adaptive reuse and conversion. Are you seeing any signs of that, and some of the challenges that we have here with conversion?
I'm seeing a lot of the adaptive reuse and renovation projects. Obviously, there's the office conversion is a hot topic. I've only looked at a few of those. I've not been brought into any of them. The ones we have looked at, obviously, I think the challenges are, how does it convert? I don't know how much we need to get into that, but I think the gist of the problems, number one, the cost of, you know, getting the piping and everything, really the plumbing systems through the concrete decks and everything, because usually your office is ideally like a 40-foot deep space, and then your cores are back in it. That doesn't align with multifamily at all, or your bathroom layouts. So you have to get a little bit creative with the floor plans and efficient. My rule of thumb is when I'm looking at doing a design for an apartment building or any type of multifamily is you need at least 10 feet of facade for each bedroom and or living room. Yeah, I'd like to have a little bit more room for the living rooms, but 10 feet's really a minimum. So if your structure and your exterior windows and spacing and everything doesn't align with that 10 feet, it gets to be very inefficient. So you have to become very creative with the floor plans to maximize your square footages. But back to your other question, what do we see going on firsthand? John, as you know, we have Newberry under construction right now. It's 416 units down in South Fayette, Bridgeville. The first phase is 277 units. That's under construction. We have another project that is under contract, NDA, but it's in the region, a 300-unit apartment building. That one is basically due to other projects in the pipeline, kind of on hold for a little bit, but I think we will be moving forward. I would say May is what I'm being told right now. Start moving forward with the design on that one. We have a third project that we are looking at in the strip with another developer. Basically, they're just kind of saying, let's wait and see where interest rates are before we really pull the trigger on anything. I think that's what we're seeing, and when we're being asked our advice, you know, to what developers should be doing. And I'm hesitant to say this because I was always pushed at my old job. Don't say this kind of stuff. It's a liability issue. You know, don't get us in trouble. But I think one of the reasons that we get hired by a lot of developers are we understand the process. We understand what your needs are, not just in the building, but other things. So to me, if you're trying to open a building, you want an apartment building opening in that window in the spring, right? For when your tenants come in, it's March to May. We tell you to work backwards from that. So if you're going to take 20 months to construct your building, let's start working back from March, 20 months before that. Then how long is it going to take us to do the drawings? Don't sign us up and bring us in. I mean, I'm shooting myself in the foot a bit. Don't sign us up and have us start drawings in January if you need drawings done the following January. Like, have us start those drawings in May or June. Because that's just money out of your pocket, and you don't need that right now.
So Brian's designing them, we're building them. Anthony, who's renting? What's historically Pittsburgh has been a very steady rent market, very steady growth market. What do you see as far as renter profile, a lifestyle choice versus a need for housing?
Sure. So, I mean, it's really sub-market dependent, right? But Pittsburgh is very driven by the meds and eds. I think that's no secret, right? As there's been heavy investment in the medical institutions, universities are growing as well. So you're going to see that constant influx. Now, there's also then, the outflux of those potential renters as well. But that demand is always going to be there. We're also seeing that people are, of course, downsizing. They want a more flexible lifestyle, and that's what multifamily, affords them, whether they have a second home elsewhere. And so this is just kind of really their home base for a more, temporary period. The housing market, with what's been going on in the housing market, we have seen that cooled slightly. There's been a little bit more permanency, but we still see that. As Laura mentioned, there's also a really strong young professional demographic in the market as well. Pittsburgh has done a really great job attracting, top tier employers, which equate to high paying jobs. What that's also allowed Pittsburgh to do is retain the talent that comes here. And this city educates, right? It used to be they'd come here for a brief period of time and then they would leave, right? That's no longer happening. There's been a much better job of that retention.
So on the urban projects that we're seeing, I would say the highest percentage of renters has some occupation involvement with healthcare. Second highest would be in the finance industry. And that kind of follows the trends of Pittsburgh, where our employment centers are. So you're seeing the same thing. And then as we get out into the suburbs, that sort of trickles out to a certain degree as well. And Laura, how does that translate from the out of town buyer perspective? I mean, is that a positive that such a high percentage of our renters are based on eds and meds?
Yeah, 18% of folks are in Pittsburgh are in medicine, 15% education. It's truly an eds and meds driven market. And now tech's on the scene gets folks really excited about Pittsburgh. Another thing is with the incomes growing, like Anthony said, we have an rent to income ratio of 22%, which is amazing. And that's just because the moderate rent increases we've seen over the past 5 years, coupled with our income growth. So, yeah, another really positive.
So then what trends are we seeing, collectively and each of you in your fields? Start with you, Brian. What trends are you seeing in the industry that are helping to, again, attract, increase rent, attract those buyers at the end of the day? What are you seeing?
Well, I'm actually headed to Nashville next week to kick off a project down there. And we're touring comps. They want to, fit in 8 comps. And the first thing they said is amenities, 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 amenities. And it reminds me back in student housing days, it was like in Pennsylvania, particularly, we had IUP and Slippery Rock and California University, all the different state system schools it was like an arms race, and they continually wanted to one up each other. And it's the same thing in multifamily. It's okay. We've got a pet wash, we've got a bike repair station, and we've got this and that. Everyone's continually trying to one up each other. And so it's what's that next flashy thing that you can do? And so it's kind of dressing up those amenities. It's coming up with an amenity that no one else has, or if they have it, how do you improve upon it? And it's not just the common space amenities, it's also inside the apartments. You know, everybody wants courts, everybody wants your LVT, it's sound. So it's, what are the little things that you can do that a renter is going to pick up on and appreciate? I think those are the trends.
And Anthony, do you echo that? I know Greystar puts together a really amazing design trends and amenity trends type of data. Are you seeing the same thing? And what can we see next? What do we expect to see next?
Yeah, so we do see the same thing. You know, we have the ability to poll roughly 1 million renters annually, and that's exactly what we do. We compile that into really great data, and some of the points that Brian had just touched on really kind of stand true, right? It's the amenity spaces, so co-working, pool, highly desirable, as well as outdoor space. Renters, you know, regardless of what generation class they fall within, they also are, they have a high priority towards fitness and well-being. So fitness centers, flex spaces, indoor, outdoor. So if anybody, you know, has had the opportunity to, you know, be at Brewer's Block, for instance, one of John's projects, I mean, it's one of the most fantastic fitness centers you will see in multifamily. And that's really been one of the driving forces for the lease-up velocity that they've seen. As far as the units, balconies, additional space that they could put a desk. So, you know, not necessarily a full-size den, but some sort of, you know, flex space or, you know, Zoom room nook is highly desirable. And then some of the other interesting things that we have seen slowly work its way up the priority list on these surveys is pre-installed Wi-Fi. So building managed Wi-Fi. Years ago, that's not necessarily something that even us on pre-consulting, we were really pushing. There's really been kind of a shift in that. Smart home features, specifically smart locks, which, you know, is nothing new, but those are some of the items. One of the ones that I find very interesting, so it was actually number 4, and, you know, a lot of pain point for operators as well as developers, package rooms and package systems. So, you know, to see that has a direct impact on the residential experience and something they're cognizant of, that when they are completing these surveys, it's like, yes, this is a pain point. I would like to see improvement there. So those are some of the trends, and, you know, that we're working with the architects, the developers, to, you know, really kind of refine our operations on.
So sticking with trends, Laura, what are you seeing from a deal structure standpoint? Because you have to be awfully creative today to get a deal across the goal line.
Yeah, I mean, I think with limited bank participation and, you know, the high equity requirements, it's requiring a lot of creativity. And in Pittsburgh, putting a deal together, you know, is part of the battle, but getting everything to pencil with hard costs where they are, with the processes. I mean, once you find the land, given our topography and the rivers, and the soils, and paying for that land, I mean, getting a deal to pencil right now with the way that, like I said, cap rates have shifted and Class A pricing has come down a bit. It's just gotten hard. So structure aside, you know, it's difficult.
Planning up front, right?
Yes.
And trying to plan for that exit on day one.
Yes.
And that's what we're seeing as well. Somewhat of a design trend. It's been around for a while, but sustainability. Here in the city of Pittsburgh, you can actually get extra bonus points, so you could build higher if you're more sustainable, which is great. And sometimes that's absolutely necessary to be able to execute on a project. What is going on in the market, though, from a buyer perspective or from outside capital, where they may not see the push for sustainability like we have in Pittsburgh? Are you seeing it as a requirement? Are you seeing it as a nicety? Or, you know, is there a return on investment if we as developers invest in sustainability?
Not a big needle moving return on investment. I mean, I think it's a nicety. I think for some bigger institutional groups, which are going to begin to show up more and more again in Pittsburgh, they have ESG requirements that they need to meet. But overall, I mean, that hasn't been a huge topic for us.
How about you, Anthony?
Yeah, so you know, we always have developers that are looking to achieve LEED certification, you know, fit well. So that's one that I, you know, worked on towards the end of last year. So yeah, to Laura's point, is there necessarily an ROI? I think that's, something that's, generally hard to quantify. But that is also something that did appear on our survey, and, in the upper 50% is that people are cognizant of the certifications that your building has. But again, it's not necessarily something that's going to, yield you particular ROI.
Is there enough data to determine whether or not there's a management cost or less of a cost if a building is a well building or a lead building?
I mean, not necessarily. As it relates to lead, yes, of course, right. With just the whole sustainability aspect, reducing your, your utility expense. Fitwell is more of a mindset for the residents, which again is something that the generations are, more cognizant of. It's not just, wellness in terms of fitness, but also, mental capacity is really important to them. So, it is of course something that we would promote if you have that certification and, really get them excited about. So yeah, we push those.
And some of these sustainability boxes that we're checking on these projects also come with potentially some subsidies. What are you guys seeing? Brian, have you worked with subsidies on any projects between RCAP and some of the other tax abatements? What are you seeing?
So we don't necessarily get too involved in that, but what Rockit, what we try to do to bring to the table, we've actually have a sort of an informal partnership with a company called EnerYields, and it's a Carnegie Mellon grad. She developed this AI algorithm. It's a really great thing for anyone here looking to do these projects. You plug in your project zip code, square footage of your building, and any environmental sustainable initiatives that you're looking at doing. And they'll come back and they'll spit out this sheet. If you want to put solar panels on your roof, there's this type of a low interest loan that's available out there. There's a government grant that's available for your project. There's this, and this. And sort of a menu type of a thing where they'll come back and say, well, if you go and get Passive House certification and you also get a Green Globe certification, you're then automatically eligible for a $500,000 grant or something. So there's stuff out there. I think there's a lot of stuff out there, especially with the infrastructure bills. It's just how do you find it? Obviously, companies like that, there's a service fee for it and things like that. What we're seeing firsthand is I think most of our developers are looking at, they want to be sustainable, but obviously in today's world, we want to do it, but we don't want it to cost us any money. So how do you do it economically? I'm actually presenting next Thursday. I got a 3.5-hour continuing education session I'm doing with RAMP, Realtors Association, Metropolitan Pittsburgh, on sustainability and tenant satisfaction. And for me, that is the key for marketing. It's marketing, it's tenant recruitment, tenant retainage. With well, I think it is, like the certification there, they say, I think it's a metric of like, 35% less sick days, in an office type of a setting. The daylighting, the mental health that goes with having the daylight, having the circadian rhythm set, better acoustics, softer, one of the things in well is the colors of the paints and materials that you use. Certain people that might be on the spectrum, not a lot of people think this, but if you have a nice red feature wall in your space, that might trigger someone mentally. So it's being cognizant of that, being cognizant of the environment, the people. It creates a better environment. We look at stuff at, one of the things I'm talking about in my presentation is like a pet wash, for instance. 10 years ago, we were doing a pet wash. It's okay. Let's do a 8x10 room in the garage. It's on the slab. You don't have to worry about water penetration. We'll just paint the walls and put a hose bib in there. Well, that's not what tenants want. Right now, try to put yourself, use a little empathy and see what the tenants want. When they're doing a pet wash, when they're touring a building and they see a pet wash in there, they don't want just somewhere to give their dog a bath. Like, a lot of these people, they're fur babies, right? They're spending 5% of their income on outfits for them. So they don't want to take them down to the dungeon in the basement. They want a room where you've got, and this is what we're doing now with in Newberry is, it's got a view of the outside. It's right next to the pet walk. So if you take your dog out for a walk, you bring them in, they're all muddy. It's right there. It's got a water heater, so it's warm water. It's not cold water. You've got ceramic tile. You've got the grooming station there. You know, the stainless steel tub that they with little steps to let them go up into there to pamper them. You know, again, it's try to put yourself in the mindset of the renters. To me, if you got someone that's touring a building and they're looking for it to be pet friendly, you want it to be pet friendly, not pet accommodating.
We're seeing about 30% of our residents have pets, dogs specifically. Anthony, are you seeing about the same thing?
We are, and it's higher, you know, in certain aspects. And, you know, we sit here and there's some chuckles you know, in the room, and, you know, there are assets where the pet wash station or pet spa, you know, as we're marketing them as, that are nicer than the in-unit bathrooms, nicer than my master bathroom, you know, in my house. So to your point, yeah, there really is an emphasis in how do you really touch that prospective renter in all aspects of their life.
So just to kind of close the loop on sustainability and design trends and things like that, we're not actually seeing that maybe on an ROI, but we are seeing it for retention and quality of life, and maybe able to squeak a little more rental increase out of those properties. Is that true?
I would just add, you know, and I'm sorry because I kind of went off the deep end with pets, but you
Just
know,
a little.
but years ago, I attended a panel that was hosted by EDR, you know, now it's owned by Greystar, and it was on millennial trends and Generation Z trends and what do they want in their student housing. And something that really has stuck with me since I heard that was there are these students that would refuse to rent, even though it was their parents' money. They'd refuse to rent off-campus housing unless it was LEED certified. And okay, what's that have to do with multifamily? Well, 10 years later, they're your tenants. So they're looking for it. Now, it might be, okay, I'm willing to spend an extra $50 a month for it or 25, or I'm not willing to spend any extra money on it. But that might be the determining factor from them going to your building versus the guy down the street that has that LEED certification. Now, what we promote is do what you can from a sustainability standpoint. I think today's renters are educated enough that they see it. So a lot of times we design to the LEED standards. Most of the stuff really doesn't cost anything, and it's stuff that your tenants want anyways. You know, bigger windows, balconies, operable windows, you know, recycled content, recycled materials, they're there. Everyone's doing it anyways. It really doesn't cost any extra. 20 years ago, it was a big deal, but not now.
We're going to go back to incentives and abatements so that we can pay for all these wonderful amenities. Laura, I guess what are you seeing? So we've done 3 projects that have a LRTA tax abatement. We've done 2 projects with an RCAP. How are you seeing the outside world come into Pittsburgh and understand our abatement system, and is it working, and how can it be improved?
Yeah, I mean, I think it's a struggle. I mean, you just referenced navigating and finding out what's available and being able to see that clearly somewhere is tough for folks coming in. And if there aren't abatement and subsidy programs that are in place, a lot of these new projects aren't going to work. These conversions that there's so much discussion about. If you're buying a downtown building, even if you can get it for a song or pay $25 a foot for a downtown office building, converting it's going to be $250 to $500, depending on existing conditions, hard costs, et cetera. And finding, you know, there need to be subsidies and tax payments for those projects to work, for ground up urban projects to work. And I think, yeah, I mean, I don't want to be negative, but I do think that just a more navigable system and process is really important. Just the differences between different LRTAs and what they require has been pretty vast based on different deals that we're underwriting and looking at how, you know, different projects have been able to benefit from them.
So a lot of the reports I've read, and one of my beliefs is more housing equates to more affordable housing. Not necessarily affordable, but more supply keeps everything in balance. Whereas Pittsburgh has been out of balance. We've had more demand than supply for a lot of the reasons we just mentioned. Tax abatements and different incentives from the local governments, I think, are absolutely required to kickstart some of these projects, especially in today's day with the interest rates where they are, labor rates and costs of materials and equipment still sky high. Nothing seems to be coming down. Where's the breaking point? And I think the breaking point is trying to obtain some of these incentives. We can go across the border to Ohio and get a LRTA or a tax abatement, a real estate tax abatement by right for 10 years. In this market, we have to go to the school district, the city, the county. County no longer supports or is involved in the LRTA program, so now they have their own thing. So it's very disjointed, and it's hard to find a path forward in the incentive process in Pittsburgh. We all want to see this improve, I think, and I don't know. Have you, Anthony? Have you seen anything? I know you have a lot of experience in Philly. Have you seen any incentives there that same state? Anything we can learn from?
So a lot of the incentives and abatements are actually dropping off the 10 years that, a lot of our clients to, had the benefit of receiving. And what that's actually causing is a bit of an issue on the trade out of the holds. Is there anything that Pittsburgh wants to adopt from the Philly market? Say no. I think Pittsburgh has done a really great job to a degree in a positive way, kind of isolating from the way the rest of these large national markets are operating. I mean, if we want to do a side-by-side comparison between the major cities in Pennsylvania, we talk about supply, and I'm sure that investors, operators, owners, everybody, that's what's really being pushed as far as the narrative for the positive outlook of Pittsburgh. This year we have roughly 1,500 Class A units delivering, and they're not clustered together, right? They are spread out throughout the entire MSA. Last year, again, a very absorbable amount. There are still a few that are absorbing, but it's always been a very kind of consistent delivery. By comparison, Philadelphia is about to receive over 8,000 units in one zip code. The Cranes, we're going to be leasing up 3 of them, and it's going to be a real challenge. And that's only part of it. There's about 20,000 units in the next 12 to 18 months that are going to be delivering in that market. And depending on what reports you look at, yes, there's growth that supports that. There's there are reports that don't support it.
So to help, I guess, offset some of the cost increases we're seeing, I know Greystar, for one, is going all in on modular, and nationally, Greystar is making this push. I think their first manufacturing facility has been started in Pennsylvania, but Greystar's very first project is here in Pittsburgh. Can you talk a little bit about that?
Yeah, so just last year, Greystar made a large investment by acquiring a pre-existing modular factory in Knox, PA, so not terribly far from here. And really why that move had been made is because as we expanded globally into European markets, Asian markets, Japan specifically, we take that knowledge and we look to implement it elsewhere, and how can we refine and create efficiencies. And so this is an area of opportunity that we saw. Now, a lot of people may think that modular allows you to significantly reduce your construction costs, and that's actually not the case. There is a marginal degree of savings, but really, where you're coming out ahead is you're reducing your construction timeline by up to 40 to 50%. Because you think about it, site work is beginning. Those modulars, those units are being built and stored off site. Now, one of the key components to making this, efficient is that there is a 400 to 500 mile radius. Now, why did they choose Pittsburgh? There's several reasons. So again, there's strong conviction on the Greystar side about the Pittsburgh market and the trajectory that it's on, as I noted earlier, throughout all of our divisions. But it's close to home, right? So this is the first one, and quite frankly, it's easier to figure out the kinks an hour and a half away than it is 6 hours away. But again, that said, really strong conviction in the market, and areas that they're targeting are the larger Pittsburgh area, Ohio, Massachusetts, an hour plus outside of Boston, and the Richmond area, as well as the Chesapeake Bay area.
Yeah, I think speed to market is going to be crucial in this rate environment and everything else going on with labor and materials. So I applaud that. Well, I think we've covered a lot of ground today, but we want to hear from you all. So we're going to open it up to some questions and answers. I think Erica is going to pass around the microphone. So we're going to open it up to the floor.
I just had a quick question in terms of amenities. What do you think the most overrated amenity is? And what do you think is the most unique amenity that you've run into?
Over, or do you want to go ahead? Okay. Unique, I think, is the appliance garage with everything from a toaster oven to a drill to an ironing board and an iron to anything that you might need. I think that's unique, and like tenants loved it. Go ahead. I don't know about.
Well, I was going to say unique. I've done music studios, soundproof rooms for recording. We've been asked about doing a sauna. I keep pushing, and it looks like it's going to go forward for an indoor pool in Pittsburgh. Like, why are we building swimming pools when you can use them 3 months out of the year? So indoor swimming pool. I think most useful, and Anthony already touched on this, is package rooms. I think every apartment building I've designed, the package room is probably doubled. Like, we're getting into 300, 400, 500 square foot package rooms right now. I think Newberry has a package room that's 25 by 40 almost, maybe 25 by 30. It's huge. And it's, Amazon. I can't really think of overrated because I think they all get used a lot.
I think some of the unique ones that I've seen in this market, podcast rooms, music rooms, as Brian indicated. There's some with kayak storage, which definitely have additional space. And they said, all right, let's have the ability to throw some kayaks in. Some of the important ones are going to be bike storage as well. So, not unique. I wouldn't necessarily say overrated, but I would say what is, we're mindful of repurposing, no longer for, kind of business. We're not doing business centers, right? They're co-working spaces. You don't need to do large conference rooms. If you have the space to do one that could potentially accommodate 6 individuals, that's great. But, 6 years ago, your business center consisted of one, open room and then potentially 2 large conference rooms. But what we're seeing, just, for better utility, is that you divide those out because it's one individual that's going to take up that space. So, we just see some efficiencies there. But, as far as overrated, I don't know if I'd, necessarily say they're more overrated than others. Good question.
Good morning, everyone. Thanks so much for your thoughts. Are we hitting apartments for lower incomes out in some of the more suburban markets? I'm thinking about the airport corridor specifically. We've got a growing workforce out there with all the industrial development. Can we afford to build multifamily to support those some of those lower incomes?
Yeah, so that's actually the whole concept behind Greystar's movement towards modular, and that's exactly what we're doing. We're attacking out west with the reduced timelines that I referenced previously. We're able to meet 80% or lower AMI. So what that does is it affords the renter who may be looking at more of a Class B product. They now can afford to be in, a new Class A asset environment.
Yeah, we're seeing the same thing in our McKnight Road project, the Foundmore. We do have studios that definitely fall into the workforce housing, the more affordable range. We're seeing people from the mall rent and different folks in the retail industry, which is great. just to kind of get into that a little bit, there's a lot of things that contribute to affordability and workforce housing, which, I think we all agree we'd love to see more of. Um, it's hard to do that in some of these suburbs where the tap fees are $5,000 and $6,000 per apartment. It's hard to do it where the tax rates are $600, $700, $800 a month per apartment. So I think if we're as a region going to have a discussion about trying to put more workforce housing online, we have to address some of the fees to make it more equitable.
So yeah, and I mean, John, I would agree to all of your points, but circling back to the Found More, one of the things that your team did unique there is add studios and apply them to a more kind of suburban urban infill location that again allow affordability because not every individual needs a 750, 820 square foot one bedroom, right? And that's what kind of puts it outside of the affordability for them. It may be sufficient enough to have a small studio or has their program one bedroom juniors that's only 600 square feet.
Question. Jeff, you're always good for a question. Yes.
Here.
Thank you. So I had a question, probably more so for Brian and John, but feel free, anybody. For projects that are ongoing, like currently in the kind of pre-construction phase or early construction phase, how are you guys figuring out where to value engineer some of this stuff? Where it's, are you adding more smaller spaces? Are you going down in quality? We've been talking a lot about amenities, but at some point, deals have to get done. And I'm on the development and investment side. And so, from our perspective, somebody who wants like an asset that might require quartz might get something cheaper. Or, we might be doing luxury vinyl tile instead of engineered hardwood. Where are you guys finding room to save to get deals across the finish line?
Well, John, we were actually working on this together, right? Over the past 6 months or so.
Yes.
And I think, one that I'm quite proud of is you guys brought to the table. It was, I think, what, a $500,000 or $600,000 VE item to value engineer the facades.
Right. I think each developer, each contractor has their own way of approach. For us, it's starting with that napkin sketch and going from there. If you don't start early, you're going to be behind on value engineering and you're going to try to catch up and usually going to cut the things that you really don't want to cut, like the gold-plated dog wash. You got to start with your site plan and then really spend a lot of time on your structure and how that stacks together and those components. Garages, with our topography here, a lot of walkout type garages can be cost feasible and get you more density if you plan it right and you execute that plan. But we take a lot of time and look at that. I would say the other big category we focus on is electrical. The electrical costs have pretty much tripled in the last 5 years on multifamily. And it's only going to get worse with the new codes coming from a cost standpoint, I guess. So you really have to plan. You have to partner with Duquesne Light and your utility provider and understand how they're going to service your project and what other options you may have. But that is a runaway cost, and that's how it's been the last 3 years. There's basically every category of scope you need to look at because there's a cap right now because of cap rates. So if you can't deliver a project for under let's say $300,000 a unit all in with land and soft costs and everything, it's not going to pencil. So you gotta start very early and work from the bottom up and the top down.
But I guess what I was going to say was we try to focus on the things that tenants are never going to notice. Anything that's behind the walls, the facades, it was only on paper. At the end of the day, the resolution we came to, no one even knew that there was any value engineering done. You know, that's what's important to us, you know, that you're not taking away from the tenant experience, the marketability of the project.
Yes.
When we talk about adaptive reuse, I'm curious to see, because of the average age of people in Pittsburgh and the, to my view, incredible number of older apartment buildings in places like the East End, Squirrel Hill, Shadyside, even places like Mount Lebanon, Bethel Park. Is there a move in institutional investors, people like Greystar, to do roll-ups of some of those buildings and try to update them to address the needs of younger, more affluent people as those older people move out?
Yeah, of course. So, you know, we do have specific clients that target value add assets. So we are working with one down in the South Hills in Bethel Park, and acquisition was October 2020, and they've seen a very successful return, upwards of 16 to 18% on the renovated units. So yes, that is something that we have clients that are specifically looking for. And to your point, Pittsburgh is a really nice market for that. So as we continue to look into 2024, 2025, that's again going to be one of our larger pushes. But of course, it's as these deals come online.
I think the smaller, sub 20 unit buildings in, like you said, Mount Lebanon, East Liberty, places like that, those are an area where we should focus. And I don't understand why there's not a specific program that helps developers and entrepreneurs turn those buildings into some sort of more modern, more updated, more safe. Most of those buildings don't have sprinklers. They have old gas stoves and boilers and things like that. They need to be updated. We need those incentives to happen because we have a lot of obsolete buildings and homes and product in Pittsburgh that it's time for it to turn. And I think that's the best path forward to workforce and affordable housing.
We'll take it in a different direction. Assuming the social commentary is correct and millennials can't buy houses and Gen Z can't buy houses and some of them are having families, is there any, and this is probably more for the two of you that see outside of this market, is there any trend towards building apartments that are either suburban or new construction that are family friendly, so that you'd have a suburb, a good school district suburb that's got housing like you'd have in Manhattan where people raise families?
Well, I'll just talk on the build to rent, single family rental movement, which has really been growing a lot. Not here yet, but it follows those high demographics and great school districts. We have shining suburbs that check those boxes with $160,000, $170,000 average household incomes and blue ribbon schools. We just don't have the space that they need for those. So, I mean, I think it's possible. And, I think John earlier was mentioning the taxes are difficult in that model. I think going up north where there's more land and it's not as difficult from a tax perspective is going to make a lot of sense. And we are going to see that. So that's, going to be more family friendly for sure.
We're actually seeing, 3-bedroom apartment units becoming more and more common, as well as playgrounds becoming an amenity, because there are going to be kids there. Another thing that we're seeing more often is like the 1+ den type of an apartment unit. So maybe if it's a family that quite can't afford to be a family yet, but they've got a kid on the way, they can put them in the den that saves them a couple $100 a month over having a 2-bedroom apartment unit. So it's
the new home industry. If you talk to any of the builders and developers in new homes right now, they'll tell you the biggest shift in the last 6 to 12 months is people are not putting that deposit down to build a new home until they sell their current home. So to your point, there is a demand, even if it's for 6 or 12 months, to go into family oriented housing. The build to rent model is catching on nationally. I think it will catch on here to a certain degree. I still think Allegheny County is going to be really difficult with our tax structure and tap fees and all that other stuff to do build to rent. But I think when you get outside into Washington County or Butler County, the build to rent it's a matter of time till we start to see that. And I think if it's done in the right way, and it's truly a master plan type community, it'll be very successful.
Yeah, and just to add that, there are eyes on the Pittsburgh market for build to rent concept, as both Laura and John mentioned. It is north of Allegheny County. We work with one of the largest home builders in America, and what they've been doing over the past 18 months, they've been actively assessing the viability of their for sale communities that are under construction and flipping them to their build to rent platform. There's also, if anybody's seen the article release, there's a $1 billion fund that we also work with outside of Greystar that is working towards the acquisitions. And historically, they were, kind of picking off single family homes here or there, but there's a lot of efficiencies by, building or purchasing these neighborhoods. To John's point, it's more prevalent kind of in the mid-Atlantic, the Carolinas, out in Arizona, but it's coming to the Northeast.
John, I think we have time for one more question.
Here.
Sorry.
Brian, this is maybe directed earlier. You had said about the conversion from office to residential, and you'd mentioned the plumbing. Is there any other key boilerplates that you would see that would discount immediately if someone was moving in that direction?
Having not done one myself, until I got into the weeds, I couldn't say for sure. I would think plumbing is the first one that comes to mind. Mechanical could certainly be an issue, unless you're okay with, the exposed duct work. I would think in that type of scenario, it's probably going to be expected. But if it's not, then that's probably not a right fit. Again, I think it comes down to the structure, just the basic structure of the apartment or the office building that would become an apartment, right? Because again, your window mullion spacing and your steel spacing is not going to lend itself to that same ideal module for an apartment layout. So I think that's more the limiting factor. It's more of an inefficiency, so it's not a construction cost thing. I think it's more of a square foot cost. So when you go in and a developer is going to look to do an apartment building, you're thinking, okay, we got 700 square foot units. When you're doing the conversion, you might have to say, okay, we're going to do 850 square foot units because we just can't fit the windows in otherwise.
Okay. Well, thank you all for coming today. I hope you enjoyed this as much as I do. We had a great panel here today, and hopefully, I'm walking away with a lot more knowledge than I had when I walked in the room today. I hope you all do the same, and we'll see you here next month. Thank you for supporting NAIOP.
Put that on.
NAIOP, National Association of Industrial Office Professionals.
NAIOP, you were involved with them.
No, they do most. I was surprised that they did multifamily because they're
Industrial base.
office and industrial.
Yeah.